There is a deduction worth up to $6,000 a year that did not even exist 2 years ago. More if you are married. And it is only one of at least 5 separate ways the tax code and Medicare quietly hand money back to people over 65. Money most retirees never claim because nobody sends a letter telling you it's there. Today, I am walking through 5 of these in plain numbers, plus 2 things I have never covered on this channel before. A Medicare trap that specifically catches widows and widowers the year they lose a spouse, and a form that lets you undo a Social Security claim entirely if you filed too early and regretted it. Whether you are single, married, or on your own after losing a spouse, at least 3 of these apply to you. So keep a running count as we go, because by the end, you will know exactly which calls to make this week. My name is Robert Hensley. For decades, I worked as a Social Security and benefits counselor, helping people navigate a system that's not exactly built to explain itself. I'm not here to sell you anything. Everything I am about to walk through comes from the actual tax code, the actual Medicare rules, and the actual Social Security regulations for this year, not a rumor someone forwarded you. Hit subscribe and turn on notifications before we start, because several of these numbers change every single year, and I update this channel the moment they do. Let us start with the one hiding directly inside your tax return, a deduction that stacks on top of everything you already knew about. Starting with the 2025 tax year, the return most of you filed earlier this year or will file next spring, there is a brand new deduction in the code just for people 65 and older, called the Senior Bonus Deduction, and it is worth up to $6,000 per person. If you are married and you are both 65 or older, that is $12,000 combined. Here is what makes this one easy to miss. It does not replace anything you already had. It stacks. For 2026, the regular standard deduction is $16,100 if you are single, $32,200 if you are married filing jointly. On top of that, a separate older provision gives everyone 65 and up an extra $2,050 if you are single, or $1,650 per qualifying spouse if you are married. And now, on top of both of those, the new $6,000 per person bonus stacks as well, which for a married couple both over 65 adds up to a total deduction of $47,500 before a single receipt or medical bill even gets counted. This one does have an income limit, so let me tell you exactly where it starts to shrink. It phases out once your modified adjusted gross income passes $75,000 single or $150,000 married, reducing gradually until it disappears completely at $175,000 single or $250,000 married. For the overwhelming majority of retirees watching this, that phase-out never touches you. You get the whole thing. Here's the part that actually matters for you this week. This deduction is temporary. As the law stands right now, it only exists for tax years 2025 through 2028, which means it is not a set-it-and-forget-it deduction. You need to confirm it was applied every single year it is on the books. If someone else prepares your return, ask them directly, did you apply the senior bonus deduction and the age 65 additional standard deduction Both of them, not just one. And that brings us to a bill where the real money tends to hide in plain sight. Your property tax is not one program. It is three different kinds, stacked on top of each other. And almost nobody has all three filed. The first is the homestead exemption, and it is the gateway to everything else on this list. It knocks a chunk of your home's assessed value off the books before the county even calculates your bill. The exact dollar amount is different in every state, and in most states it is not automatic. You file a one-page form with the county, usually before a spring deadline, and in many states it stays on file for as long as you own the home. The second is a separate senior or age 65 exemption layered on top of the homestead. And here is where comfortable retirees wrongly assume they are excluded. They hear senior exemption and picture an income test. But in more than half the states that offer this, age alone is the only qualification. No income check at all. The third and the most valuable of the three is an assessment freeze, which locks in your home's taxable value at whatever it was the year you filed, no matter how much your neighborhood appreciates after that. Picture a man named Franklin, 71 years old, sitting in a home that has doubled in value over the 20 years he has owned it, never having filed a single one of these three forms because he assumed the county would handle it automatically. Once Franklin filed his homestead exemption, then the separate senior exemption on top of it, then the assessment freeze locking his taxable value at that year's number. His school district tax bill stopped moving entirely, and it does not matter how much his neighborhood keeps appreciating from here forward. That particular bill is frozen for as long as he owns the home. And if you are renting right now, this affects you too, even though it does not feel like it. Your landlord pays that property tax bill, and every dollar of increase gets passed straight into your rent. So when property taxes freeze or drop across a community, red stops climbing the way it has been. The action here is one phone call to your county assessor's office. Ask them by name. Is the homestead exemption, the senior exemption, and the assessment freeze on file for my property? Bill number 3 is the tax on your Social Security check itself. And there is more confusion around this one than almost anything else in retirement. Whether your benefit is taxed and how much comes down to one number the IRS calls your provisional income, roughly your other income plus half your Social Security benefit. If you are single and that combined number stays under $25,000, none of your Social Security is taxable. If you are married filing jointly, the line is $32,000. Above those thresholds, up to 50% and eventually up to 85% of your benefit can become taxable. But notice that even at the very top, 15% of your Social Security is always tax-free no matter what. Here is a mistake I see at every income level. When people first sign up for Social Security, a form called the W-4V asks whether you want federal tax withheld automatically from every check. And a lot of people pick 10 or 12 or 22% just to feel safe. Then at tax time, a chunk of that comes back as a refund, and it feels like a bonus. It is not. That refund is an interest-free loan you gave the federal government all year. And if your senior bonus deduction and your age 65 add-on have brought your real tax bill down, That withholding is very likely too high now. So file a new W-4V. Review the actual number with your return and stop the free loan. There is a piece almost nobody checks. Your state may not tax any of this at all. As of 2026, 41 states plus Washington, D.C. do not tax Social Security benefits. Only a handful still do in any form. Connecticut, Minnesota, Rhode Island, Utah, and Vermont. And West Virginia just finished phasing its tax out completely. So even that one is gone as of returns filed for this year. If you are in one of those few remaining states, look up your state's specific exemption, because most of them still protect lower and middle-income retirees, even where the tax technically exists on the books. And that brings us to the bill that surprises the most people once they hear the real number. Bill number 4 is your Medicare Part B premium, and I want you to pay close attention because the number most people have in their head is wrong. For 2026, the standard Part B premium is $202.90 a month, automatically deducted from your Social Security check before it ever lands in your account, up nearly 10% from last year. In an earlier video, I walked through the Medicare savings programs and extra help in full detail. The programs where your state can pay that premium for you entirely based on your income. So I will not repeat all of it here. But if you have not checked whether you qualify, that video is worth watching, because it alone can be worth more than $2,000 a year. What I have not covered before is a separate charge called IRMAA, an income-related surcharge added on top of your Part B and Part D premiums for higher income retirees. And the strange part is exactly how Medicare decides who owes it. Medicare calculates this surcharge off your tax return from 2 years ago, not your current income. So if you were working and earning a strong salary 2 years before you retired, and your income has since dropped, you can end up paying a surcharge based on money you are no longer making at all. There is a specific fix for this, Form SSA-44. And if you have had what the government calls a life-changing event, retirement, the death of a spouse, divorce, or a significant drop in income, you file the SSA-44. Show Medicare your current income, and they recalculate the surcharge using real numbers instead of outdated ones. It takes about 45 minutes, and almost nobody files it because almost nobody knows it exists. There is one specific version of this that catches people at the worst possible moment, and it is one of the 2 things I promised you at the very start of this video. It is called the Widow's Medicare Cliff, and here is exactly how it catches people. Remember that IRMAA looks at your household income from 2 years ago, and specifically your filing status from 2 years ago. If a couple filed jointly, their combined income was measured against the married thresholds, which are roughly double the single thresholds. The year a spouse passes away, the surviving spouse's filing status changes to single the very next tax year. But Medicare is still looking at income that was earned as a couple, which means a widow or widower can suddenly be measured against the single filer IRMAA thresholds using income that was based on 2 incomes and get hit with a surcharge that never applied to them as an individual, arriving in the exact same year they lost their spouse. The fix is the same SSA 44 form. The death of a spouse is explicitly listed as a qualifying life-changing event. But almost nobody realizes they need to file it a second time, specifically because their filing status changed, not just their income. Picture a couple with $210,000 in combined income the year before one of them passes away, under the married IRMAA threshold. No surcharge applies at all. Now picture the surviving spouse. I will call her Marjorie, whose own income going forward is only $95,000, comfortably under the single threshold too. But Medicare is still working off that old joint return. So Marjorie gets placed into a surcharge tier meant for a single filer earning far more than she actually makes. Sometimes an extra $80 to $200 a month on top of the $202.90 base premium, landing in the exact year her household income just dropped, and her grief was already at its heaviest. It does correct itself 2 years later on its own, but that is 2 years of an inflated bill nobody has to sit through if the SSA 44 gets filed right away. If you have lost a spouse in the last 2 years, or you know someone who has, check whether Medicare ever recalculated based on the new filing status. Now, let me cover something worth more than everything so far combined for the right person. Someone who has built up real equity in a home. If you have lived in your home as your primary residence for at least 2 of the last 5 years, you can sell it and exclude up to $250,000 of the gain from tax if you are single, up to $500,000 if you are married filing jointly. That is the gain, what you sold it for minus what you paid minus major improvements, not the sale price itself. A couple who bought a house decades ago for $70,000 that is now worth $400,000 has roughly $330,000 of gain. And as a married couple, they can exclude $500,000 of it. So their federal tax bill on that sale is zero. A lot of retirees stay in a home that has grown too big or too expensive to maintain because they are afraid of a tax bill that, for most people in this exact situation, was never actually coming. There is a second window worth understanding in that same low-income stretch after retirement, a Roth conversion. Money in a traditional IRA or old 401k has never been taxed. Every dollar you pull out gets taxed as ordinary income, and eventually, the IRS forces you to start pulling it out, whether you need it or not. In the years after you retire and before those required withdrawals begin, when your income is often at its lowest point in decades, you can deliberately convert some of that IRA money into a Roth IRA. Pay tax on it now at your current lower bracket, and from then on it grows completely tax-free with no required withdrawals ever attached. In that same window, for 2026, a single filer can have taxable income up to $49,450, or a married couple up to $98,900, and still pay zero federal tax on long-term capital gains. After your standard deduction, after the age 65 add-on, after the new senior bonus. If your income is genuinely low during that stretch, it is the window to sell appreciated investments without owing a dollar in federal tax on the gain. That low-income window closes the moment required minimum distributions begin. Once you turn 73 or 75, depending on your birth year, and the IRS forces you to withdraw a minimum amount from a traditional IRA every year, whether you need the money or not. Counted as ordinary income, which can push more of your Social Security into taxable territory and trigger that IRMAA surcharge in the very same year. If you are charitably inclined, once you turn 70 and a half, you can send money directly from your IRA to a qualified charity, up to $111,000 a year as of 2026, and it counts towards satisfying your required withdrawal without ever counting as taxable income at all, called a qualified charitable distribution. Because most retirees now take the standard deduction, this is often the only way your giving actually lowers your tax bill. But the money has to move directly from the IRA custodian to the charity. If it touches your own account first, it no longer qualifies. Here is the second thing I promised you at the start. A fix for a mistake that happens more often than you would think. Claiming Social Security and immediately regretting the number. If you file for Social Security within the last 12 months and you now realize you claimed too early or the amount is lower than you expected, there is a form called SSA 521 that lets you withdraw your application entirely, as if you never filed. You repay whatever benefits you have already received with no interest, and your benefit resets, growing back at the higher rate for every month you wait afterward. There is one important limit. You can only do this once in your entire lifetime, so it is not something to use casually. But if you are inside that 12-month window right now, and you know the number you locked in was not the right one, this is the one form that lets you undo it cleanly instead of living with a lower check for the rest of your life. So here is what I would do this week, in order. First, call your county assessor and ask about the homestead exemption, the senior exemption, and the assessment freeze by name. Second, when your return is prepared, confirm both your senior bonus deduction and your age 65 additional standard deduction were applied, and adjust your W-4V if your withholding looks too high now. Third, if you have lost a spouse in the last 2 years, check whether Medicare ever recalculated their IRMAA based on the new filing status. And fourth, if you are inside 12 months of a Social Security claim you regret, look into SSA 521 before that window closes. Exemptions, income limits, and program rules vary by state and change over time, so confirm your own specific situation with your county, a tax professional, or the Social Security Administration before acting on anything in this video. If you know a parent, a neighbor, or a friend over 65, please share this video with them today. And if you've got a question about your own situation, drop it in the comments. Every Friday, I answer real viewer questions over on my Posts tab. If this helped you, hit that subscribe button and the bell so you catch every video the moment it goes live. This channel provides educational information only and is not affiliated with the Social Security Administration, Medicare, CMS, the IRS, or any bank.